Namaskar. We are here today to review the IPO of UTI AMC. Uh, viewers would recall that UTI set up its schemes in 1964, that is 55 years ago. It is the oldest mutual fund company in the country. Let's understand that UTI is having a track record which would be very difficult to match by anybody else. As far as the distribution channel is concerned, being such an old institution, they have a very large distribution base. They also have 53,000 independent financial advisors who are working with them. If we come to the AUM of the industry, at an industry level, the AUM has grown from 12 lakh crores to 25 lakh crores in the period 2015 to 2020 and is expected to grow from 27 lakh crore to 52 lakh crore in 5 years. While UTI has not been able to grow as per the industry and has actually shown some degrowth during the period 2015 to 2020, they are now well set to record industry average in this next 5 year period. In terms of sheer size, they have 109 million live folios. It's a digital platform that they are using. They are fully geared to meet the new demand that is coming in from various investors. On the B30, T30 front, that is the metros and the major cities and the tier 2 towns, tier 2, tier 3 towns, they have an almost equal ratio with a slightly higher ratio tilted to the B30, which effectively means that they have the capacity to incentivize any collections coming in from the tier 2, tier 3 towns. In terms of competition, you have two listed entities, the first being HDFC AMC and the second being Nippon Asset Management. The offer that is being done is fairly attractive to compared to both the companies, and one could say that it is being offered at a discount to the valuation that both these companies enjoy, even to the second place player, that is Nippon Asset Management. The company had suffered a setback in 2016, 17, 18 when their fixed income debt instruments took a slight beating and did not fare well at the market, which led to their AUMs being under pressure. Post that setback, what they have done is set a lot of systems in place which allows them to do better going forward. They have an ESOP in place for their senior management, which includes the people who are actually managing and running the schemes, whether they be equity or debt. Currently, many of the equity-related schemes are the top performing schemes in their sector or space, as you could call it. And UTI seems to be getting their act back together. They also have a large variable pay, which is based on performance, evaluation, and the actual merit that the fund manager is informed, which incentivizes them to perform better. This would ensure that key management personnel on the operations front stay with the funds, stay with the schemes for a long time. All of us would recall that when a fund manager leaves a particular fund house and joins another one, there is always a churn in his unit holders. They tend to exit the schemes where the fund manager has left and join the fund or the scheme where he has joined thereafter. So all this points to if I could say the word, a new UTI emerging post this issue. In terms of subscription, it's a large offering, and therefore one could expect that the retail portion would be subscribed between 2.5 times to 3.5 times, giving better chances of allotment to retail investors. I hope you enjoyed hearing the short review. Thank you very much.